Inflation cooled slightly at the start of this year, but it is still persistently high. I'm Michelle Makori, and this is Kitco News. The Consumer Price Index climbed 6.4% in January from a year earlier, edging down from 6.5% in December. Now, this is the seventh straight month of inflation cooling since peaking at 9.1% in June, which was the highest reading since 1981. So what does this mean for the Fed? What does this mean for the likelihood of a recession or perhaps even a soft landing? And how should investors be digesting this? Let's bring in my power panel to discuss: David Nelson and Gary Wagner. David is the host of the Money Runner podcast and chief strategist at Belpointe Asset Management, which has $3.3 billion in assets under management. David founded his own investment firm in 2000. Prior to that, he was a portfolio manager at Lehman Brothers and has also worked at Morgan Stanley and Merrill Lynch, with over 3 decades of experience in the financial sector. And also joining me is Kitco contributor Gary Wagner. He is, of course, the founder and CEO of the goldforecast.com. And Gary has been a technical market analyst for over 35 years and developed one of the first computer programs to recognize and identify candlestick trading patterns. Gary, a regular here on Kitco, but the first time I have the pleasure of chatting with you. So welcome, Gary, and nice to see you again, David.
Hey, thanks. Thank you.
Thanks so much for having me.
All right. So happy Valentine's Day and happy Inflation Day, gentlemen. David, I'm going to start with you because a lot of this is in how we interpret the data. Now, the CPI was forecast to come in at 6.2%, depending on who you speak to, compared to the rise of 6.5% in the December report, came in at 6.4%. But it is easing. The question is it easing enough? What is your read here, David? Have we hit peak inflation?
I think we can agree, Michelle, that peak inflation is largely behind us. But therein lies the issue that the markets are wrestling with right now. We've gone from 9 down to 6. Even if we get to 5 to 4, going that last mile is what the market is wrestling with right now. And I think it's pretty clear that the Fed's job just isn't done yet. And that's what the markets are trying to adjust to. And there's been a large reset in just the last couple of weeks. Chair Powell's last speech, which was around the jobs, the last jobs number that we got, markets were largely pricing in as many as 3 rate cuts this year. A lot of that's gone away. I look at the terminal rate right now; it's sitting, somewhere north of 5%. That's kind of in line with the Fed thinking, and those cuts that the markets were pricing in, they're not there, and the markets seem to be pretty resilient, and they're largely pricing in right now the idea of a soft landing. And I think that's what we're going to have to wrestle out as to whether or not that's the case.
Right. And of course, we're going to distinguish between the equity markets and the gold markets here. And we're going to bring Gary Wagner to weigh in on that. Gary, let's first start off with your read on this data and what it means for likely Fed action come the next meeting, because the general consensus, as David pointed out, was that the Fed would continue to raise, perhaps pause come May. Do you think that direction has now changed? What's your take?
The main point that I'd like to bring up is the fact that beginning at the Jackson Hole Symposium, Chairman Powell delivered a pretty stern message, and that was they would do whatever it takes, and no matter how long it took, they would go to their target of 2%. I still find it difficult to believe that they'll achieve that. But what's most important is he underscored on multiple occasions that they would keep rates elevated throughout 2023. And yet the investment public kind of pushed that aside and said, no, they'll blink, there'll be a rate cut. And I think the realization that won't happen is what is sinking in right now, and the most important takeaway for me.
That realization perhaps is hitting the gold market. We did see gold come down a little bit on the day, scoring a 5-week low. So the gold market, Gary, is thinking, okay, maybe the Fed will be more aggressive, or maybe Powell will stay the course and That's why we're not seeing, that's why we saw a slight drop in gold?
Well, the way that I look at it, of course, higher inflation is a bullish undertone for gold, but raising rates does the opposite. So the fact that the jobs report was robust and we had a report that says inflation is still ticking down, says that Powell has the ammunition to continue to raise rates and not crash the economy. The concern was they were being too aggressive and it would have a detrimental effect on economic growth. Of course, their tools of reducing inflation are to contract the economy. So it's a balancing act. And what the Fed has between the jobs report and today's report is the fact that although they have been overly aggressive, they have not caused any very strong damage, and they can maintain the course, which is rate hikes 5 to 5.1%, and to maintain that elevated rate throughout the entire year.
All right, David, to Gary's point, we do have a very mixed picture of the economy right now. Inflation is cooling, yes, but perhaps not as fast as the Fed would like. And we also still have a very strong job market, with non-farm jobs rising by 517,000 in January. Unemployment is at a 53-year low. It fell to 3.4% in January. That's the lowest jobless level since May 1969. So that gives the Fed some room to work. And yet, as we said, inflation's still high, cooling, but not cooling fast enough. But this does now give people some kind of hope that a soft landing could be likely. What do you expect here? A recession, or is a soft landing looking more and more likely?
Therein lies the conundrum, Michelle, because there's a large disconnect between the data and the markets. The markets seem to be looking through everything that Gary just talked about. If you look at the inverted yield curve right now, if we don't get a recession this year, it's going to be the first time in a half century that a yield curve this inverted got the data wrong. If you go back to the last 11 cycles like this, every single time the market bottomed during the recession or sometime after, never before. And the markets right now are kind of hanging into the idea that maybe we can get through this without a recession. It's going to be unprecedented. But to a large degree, that destruction in jobs that we were looking for, it's happening certainly at the high end in technology, but by and large, a lot of people can get work as they were and they can get the raise, and that's what the Fed is worried about.
So, David, what would it mean if, in fact, as you say, this would be the first time in a half a century that the yield curve got the data wrong?
It becomes a soft landing. Maybe it hasn't happened before, but doesn't mean it can't happen. The yield curve is largely being controlled right now by the Fed. Every time we get, bad data, the 10-year starts to come in, but that, of course, the short end of the curve, what the Fed controls, is rock solid up there. And that creates a drag for equity markets. The TINA, the idea that there is no other alternative to equity, that's largely gone. And right now you can park money in short-term instruments and get well above 4%. That's pretty exciting right now. And everything revolves around the risk-free rate. So we've had a big correction in the market over the last year. A lot of those egregious multiples that we had in technology, they've come in, but they're still pretty rich. Each tick higher from the Federal Reserve makes it that much more difficult for guys like me.
Right. And David, Fed's Chair Powell was talking about disinflationary forces at play recently, but these numbers coming out show that the central bank probably still has work to do. The question is how much work it will allow itself to do. So what is your sense of this idea of a pause or a pivot? The consensus had been, as I mentioned earlier, that come the second half of 2023, that the Fed would at the very least pause, if not pivot. Are we seeing that sentiment in the market change now following this data?
I think clearly the market expects at worst that they're gonna pause. I don't know that they're expecting a pivot at this point. I don't see that. I think we're in for higher for longer, and we're likely to stay, as Gary pointed out, we'll probably stay somewhere near 5% throughout this year. But if we can make it through, say, the midpoint of the year, the good news for stocks is that even though we're in the middle of an earnings recession and earnings aren't going to rise much this year, probably be flat at best, by the middle of the year, we won't care about that. Portfolio managers like myself are going to be looking forward 12 months, and that's going to include part of 2024, where the earnings picture looks a lot better. So it's all about, what we pay for the multiple right now in stocks right now. Very, very dependent on the Fed funds rate.
All right, so I'm going to stick with the markets theme before we get back to gold. David, what do you then anticipate to be the biggest risk to the market at the moment?
The biggest risk to the market isn't the Federal Reserve. It's in fact, it's Washington on a lot of levels. We had an administration make a number of poor decisions that I think history are going to judge in a bad light. That let a spycraft float across the United States. Every corner of the planet is a geopolitical hotspot. We let that float across the United States. Now we're shooting down just about everything with a flight plan. Just yesterday, you had 26 million barrels are going to be released again from the SPR. That's on top of the 186 million barrels. That puts us just one hurricane away from a crisis. And now you have the Democrats and the Republicans duking it out, playing chicken over the debt ceiling. And that's where gold may really have some action right there. If you think back to 2011, that was disastrous. It took markets to settle the score. Markets came in about 18% in less than 2 weeks. And we're setting ourselves up for the same playbook.
Gary, what are your thoughts there, especially as David mentions these heightened geopolitical tensions, which gold so far has not been responding to?
Well, I think David's points were spot on. And the one thing that I worry about is I believe that it is highly possible that at some point inflation becomes sticky or persistent again. It was easier to move it from 9.1 down to the levels we are at, but there will come a point, I believe, in which it will be a little bit more troublesome. And that's very, very important to know, because if that happens, it kind of throws a wrench into the plan that the Federal Reserve is executing. The point that David made that is so important is that the Fed alone cannot solve this problem. If any of us had ran our households the way the administration runs the country, we'd be in bankruptcy court. You can't spend more than you have. And then we hit the debt ceiling. And then everybody does an 11th hour save while they add stuff to the bill to self-serve themselves or their constituents. And so the Federal Reserve can do so much. But if the administration keeps spending in the way that they have, it's almost a unwinnable task. And then lastly, the revision that came out from the December numbers showed that where it was showing that inflation ticked down, it actually ticked up. And so it bodes the question, how realistic are these numbers? And are the revisions more important than the release of the numbers? And so that would be my take.
Well, Gary, how realistic are these numbers? That's a whole other much broader conversation to dig deeper into, but it is, what the markets and what the Fed at least says that it works off. But Gary, let's touch on this point of the sort of disconnect between fiscal policy and monetary policy and what the Fed may have to do as a result of the government spending, because the federal government's interest payments have risen. At the start of 2022, the federal government was paying $600 billion in interest. It's now paying $850 billion. So will the rising federal debt, along with the political drama behind the debt ceiling negotiations there, in fact, force the Fed to reverse and cause a pivot?
That's an interesting question. My sense is that they're going to have a plan and try to execute that plan. They know what they can control and what they cannot. The key right now, as you mentioned, the national debt is in excess of 30 trillion. I believe it's 31 trillion. The debt payments are much higher. And I've heard analysts speak both ways, that they can get away with continuing and it's sustainable. I personally find it difficult to accept that it is sustainable forever. So they have to be able to manage it within a timely manner. And the key is whether or not we will see a continued reduction of headline inflation, because the Fed focuses on core or PCE, which strips out energy and it strips out food. And those are items that I believe are harder to control in terms of reducing inflation. You can affect the mortgage market or home market by raising rates to a point where many people can't get qualified. So what happens then? The renters are going to have to pay more rent, even if their landlords secured mortgages at lower rates. And so that is a troublesome problem. But the key is the Fed has really shown their resolve to get the job done, but they can only do so much. So the administration and the Fed have got to work together, and they've got to help us pay bills in a timely manner.
Okay. You mentioned energy, and I know, David, you were discussing earlier today the idea of how the U.S. selling off its strategic petroleum reserves can come back to bite the Biden administration very severely and potentially sooner than they would even expect. Break that down for us.
They're going to have to put it back. There's no other way out. At some point in time, they're going to have to refill this thing. It's a strategic petroleum reserve for a reason. We have it there in terms of a crisis. And a crisis isn't just because prices at the pump, went higher and you're not going to get elected. He did this right in front of an election cycle, so it was obviously very political. But at some point in time, they're going to have to put that back. He said that he doesn't want to do that until it gets to his price, which I think is around $70 a barrel. He may not see that. And at some point, we'll have to put that back. The administration's energy policy, by and large, has been suspect at best. But the problems that I see out of Washington, Michelle, if I can deviate just for a second, are even larger. We have to get smarter about how we spend money. We need a national defense. I think we can all agree with that. We saw the balloons drift across our continent. We have a defense budget that is quite high and is likely got to go higher because of the threats that we have. But we have to spend our money more wisely. I did a back of the envelope calculation of what it cost us to shoot down that balloon. It was about $67 billion. We produced the F-22 program that started decades ago. Its first air-to-air kill was a balloon. That's a lot of money to spend on a weapons program that hasn't seen a lot of use, and is even right now, after spending all that money, is being phased out for the next system. We don't do these things right, and a lot of that is really what happens in Congress, because it's about self-serving, about getting reelected, and if you cancel out a base in your home district, you're not going to get reelected. We need politicians that think more about their country and less about getting reelected.
Well, doesn't that sound like a beautiful world that you're painting there, David? Don't know if that's a possibility. That's kind of how politics work. Look, $67 billion, that's certainly a very hefty price tag to shoot down a balloon, but you've also got to look at investment in the program, perhaps as a deterrent. Just because we're not necessarily using these F-16s and other things that the U.S. has invested in doesn't mean that it doesn't have a deterrent value. But that's probably more of a conversation for a military analyst to have on the show. What I am curious about, though, David, is you're looking at this. Obviously, you're disenchanted with Washington and politics. You're certainly not alone in that sentiment, I would think. What are you investing then at the moment? We've had a lot of people come on the show and point out that the big sector of the year that is going to rise no matter what is going to be energy, because of a lot of this mismanagement and a lot of other geopolitical factors as well. But what is David Nelson looking at on the upside?
For the first time in a long time, outside of utilities and real estate, I'm pretty well invested across every sector. But the sector that's really done the best for me right now is the communication sector, which was the hands down loser last year. Meta is still a holding for us. And even after this monster run that it's had on the heels of its earnings report, it's still cheap. It still trades well under a market multiple. It's going to generate about $15 billion in free cash flow, and it's going to grow in double digits next year. The other name that's worked for us is Netflix. And I recently just sold Disney. Disney was profitable, maybe not to a large degree, but I looked at the quarter and I said, you know what, this has still got a lot of hair on it. And Bob Iger may be considered a great CEO, was there during, Disney's reign, but he's made a lot of mistakes as well. I think the biggest mistake he made was not buying Netflix. He spent billions upon billions of dollars trying to move into streaming when they could have easily bought Netflix with the same amount of money. They spent billions buying back their own stock. That was really the mistake. Everybody touts Disney's Disney Plus in comparison to Netflix, but when you're giving it away as they are, it's totally underpriced. Of course, you're going to get a lot of customers.
When you're giving what, Netflix away?
No, when you're giving Disney Plus away, they charge way under the market value of what Disney Plus is. Netflix, I think, is the hands down winner in the streaming space. Everybody's trying to get in.
When you were talking about giving Netflix away, I thought you were referring to this idea of, up until now, people have been able to share their passwords with friends and family. And we know that Netflix is recently saying that it's really going to clamp down on sharing passwords with each other. So it seems like they're not happy about Netflix being given away to the degree that it has been, even though they're charging what you say is the correct rate. What do you make of that strategy? Do you think that that is going to help or hurt Netflix as it really starts to enforce the password sharing strategy?
It's complicated, and I've talked to a lot of analysts about it. I've noticed it as well. I'm a Netflix subscriber. I saw it come across that they're doing that, and I've talked to other people using the platform. They've been shut out. So initially there might be a revenue drain, but they have to do it. You can't give away your product. You just can't give it away. It's not a business model. I think they'll succeed in that, and frankly, I look at it now, and the content seems to me a lot better. I wasn't really a big fan of it for years, and they obviously don't cater to maybe my demographic, but I'm finding a lot of shows right now on Netflix that I like a lot.
What's your favorite show on Netflix at the moment, David?
My favorite show, and I can't wait for them to do season 2, was The Recruit. I thought that was awesome. It's, a CIA. I kind of gravitate to that. But it was an exciting show. It just ended for me. I'm waiting for season 2.
All right. So you're long on Netflix, you're long on Meta, and you're long on The Recruit, a CIA show. I'm going to use that to spin back into Gary and a geopolitical discussion. Gary, what are your thoughts if there is some good news? We're always focused on the bad news here, but in the event that there is some kind of positive diplomatic resolution with the Russian invasion of Ukraine, it's about a year since that invasion began. What are your thoughts if there could be a pleasant surprise to the upside? What would that mean for gold?
I could be optimistic, but honestly, it wouldn't be realistic. I think that Putin has dug into the dirt and he's so committed. I believe a lot of it has to do with ego and the belief that he wants to be a great leader of the Russian Empire. I don't see him backing down easily, even though we have had all of the Western countries kind of join in and support Ukraine. The one thing that we have to be careful about is that he's weaponizing oil because he's using that as a tool, since they are such a large producer, to kind of move his narrative along. I wish I could be optimistic about what's going on in Ukraine, but I wouldn't be speaking my heart or what I honestly believe. I don't know what the end game is, but it will come down to an end game where one side or the other gives up, and I don't see the commitment on either side getting to that point. Hopefully, the Western Alliance and NATO put so much pressure on Putin, or internal pressures come from a sustained war that the Russian people do not want. The bottom line is it is going to be a difficult, at best, scenario to find a solution. My concern is the fact that he is using oil in a different way to almost weaponize it, so to speak, and use it against some of the NATO alliance countries that really need it and have depended on it.
So, Gary, the consensus going into 2023 has been that gold is going to hit a new all-time high this year. Is that your position?
That has been my position. The key right now is I believe that it will continue to trade under pressure as long as rate hikes continue. In terms of the question you asked before, will the Federal Reserve at some point take a pause? They almost have to, because there is a definitive lag time between a rate hike and seeing how that kind of works into the economy. So by raising rates consistently, we had 7 rate hikes out of 7 FOMC meetings beginning in March through December. Now it looks like we know we had one in January. The belief, especially from today's report, we'll have another one. At some point, he has to pause for a month or two to see if there's a bite to his actions before he can just raise his rates again. It does no one any good to raise rates and not wait to see what the ultimate effect is.
I think that's a fair assumption, and I think that's what the markets are expecting as well, that we'll see at least one other rate hike and then perhaps a pause, hold it steady, wait to see how these rate hikes take shape and impact the markets. Broadly speaking, Gary, though, would you agree that the biggest risk to the market and perhaps even the economy is, as David says, Washington, D.C.?
Absolutely. Absolutely. The Federal Reserve can only do so much to solve the problem. And without it unifying with the administration towards a common goal, they're treading water. Because it's necessary that we get our budget into alignment, make it sensible, and have some sort of long-term plan to eventually reduce items that might not be so necessary and are more politically motivated, as we are in an election year and the constituents need to see results. That's going to be the wild card. But they have to work together closely, and it cannot be accomplished by just the Federal Reserve or just the administration. They have to work together.
All right, David Nelson, final thoughts.
You know, I'd like to touch on what Gary said. Maybe the biggest concern for me with Ukraine, and it should be a concern for the world, is that all the off-ramps are being taken away. Any possibility of a negotiated settlement on this seems to be gone. Like Gary said, Putin is dug in. He's not going anywhere. And it seems that the administration, Europe, there seems to be no chance that we can come to some kind of agreement, maybe pull back the idea that Ukraine's going to be part of NATO, whereas this is how this whole thing started. Those off-ramps are gone at this point, and it could come to a head, and it'll be a problem for the world.
So you're saying it's more likely that it comes to a head than there's a diplomatic off-ramp?
I don't think there's going to be a diplomatic off-ramp. It doesn't seem like either side wants that. They want this to go to its natural end. What that is, I'm not sure.
Yeah, what would that natural end then involve?
It could be pretty ugly. And don't underestimate Putin. You know, the idea of a nuclear exchange is not out of the question. They have tactical nukes everywhere. These are small nuclear bombs that don't destroy a lot of territory. They destroy small areas of even a city. You can even compartmentalize it. I've studied it pretty closely. It's a serious threat.
It doesn't seem as though the idea of a nuclear threat is being priced into any market, really.
You're already talking about somebody who's actually fired weapons at a nuclear installation. So why wouldn't he do that? They could have easily have created some kind of horrible circumstance in the early part of this war when they fired those weapons.
I don't necessarily disagree, and yet I'm saying that surprisingly enough, the markets, equity markets, aren't pricing it in, and even gold markets aren't really pricing in the idea of a potential nuclear showdown.
They'll price it in on the day it happens.
So much for us looking to the markets as forward indicators then.
I guess it's not much of a leading indicator when it comes to this.
All right. I think we were better off chatting about your favorite Netflix shows, David, but I don't think you're wrong in highlighting this. We've certainly had a lot of people on the show that have highlighted the threat of a potential nuclear showdown this year, and that doomsday clock, which measures the likelihood of a nuclear attack, is at its highest point of alert since it was invented at, I believe, 90 seconds to midnight, which is nuclear Armageddon. Love ending a Valentine's Day show on such a positive note, nuclear Armageddon. David, Nelson, always good to see you. Gary Wagner, pleasure to have you on. Thank you so much.
Thank you.
Thank you, Michelle.
All right, and thank you for watching Kitco News. I'm Michelle Makori. Keep it right here.